we've got Will Fairbairn, who is at Agicap. Will, welcome to the show, and thanks for taking the time to speak to us.
Hi, Andy. It's great to be here and speaking with your community.
So, Will, tell us a little bit about both yourself and also Agicap. But I know you've recently joined the firm, so tell us a little bit about how you ended up here.
Sure, sounds good. So I've just finished up a 7-year stint in consulting, 7 quite long years, but really came across Agicap and I was so excited. You know, what Agicap solves is cash is the most important metric in a business, but it's so often overlooked. And then leaders are surprised when they don't have as much cash as they expected. So Agicap solves that, creates an ultimate source of truth on cash, helps forecasts and other business intelligence. And so for me, looking at the next couple of years where it was this, slightly challenging economic climate for the UK, I was really excited about how Agicap could help a number of UK businesses.
So rather than paying expensive money for a consultancy, now you've gone and joined the software firm that works it all out for you.
Exactly. Automates the work I used to do.
Fair enough. So Agicap is, well, do you want to describe exactly what it does in a nutshell?
Yeah, for sure. So the first thing we do is integrate across all the relevant data to getting that single source of truth on cash. So that's all your bank accounts, your accounting software, any ERPs you have. We can integrate your Excel models, however you're doing your invoices. We bring that all into one place to get that source of truth on cash. And then we help you do a cash flow forecast off the back of that. And once we've got that in place, we can help build out some dashboarding to help you make decisions. So we bring it all together, and then that gives business leaders a great view on how they can grow their recruiting agency, whether they should make that next hire. Yeah.
So obviously working in recruitment, what's your observation about recruitment firms? I think, even when I worked for a big corporate, there was still a lot of confusion around what was sales, what was in the financial, what was P&L, what was cash, and people would talk about it and interchange it quite a lot. Is this something you're seeing in your work?
I couldn't agree more, Andy, completely. We've got a number of recruiting partnership customers and a number of service industry customers as well. It probably seems to me recruiting is really a sales-driven business. Recruiters are fantastic at understanding their market, what skill needs their candidates have, but fundamentally they have to sell. But then sales reporting is for sure not cash reporting. And the bigger a recruiting agency becomes, the more they'll see that and more risk of that unhappy surprise. Yeah, for sure we see that that difference in reporting versus cash in comes up a ton.
I was going to say, if you've got a really simple way of explaining it for us recruiting folk.
Yeah, for sure. I can have a go. But look, I guess one of the things that happens in recruiting, at least on we'll keep it easy and just do cash inflows that can happen. Let's say March, we have a fantastic month. You do £100,000 of revenue. But then it's going to be a long way away from getting £100,000 cash in. If you had debtor days of 60, you're waiting 60 days to get cash in from each customer. That means in a given month, you're probably owed £200,000 in accounts receivable. So this is huge amount of cash outlay. You're kind of lending money all the time to your customers. And the faster you grow, the more this is happening. And that's just on the cash inflow side. But there's always that big disconnect between revenue versus cash, driven by topics like billing times, payment terms, and of course, when a customer actually pays, which is not always when the payment terms set, as I'm sure you'll see.
Yeah, I mean, I guess you're a recruitment consultant. You place a candidate, you think it's all over when the bell rings, but typically there's always if you're on permanent, there's notice periods, so people won't start immediately, so it's only recognizable when it's invoiced. Generally, most perm revenue recognition's based on invoice date, which is start date. And then on contract, it's again, you're effectively funding the worker until you get paid.
Super hard. I guess what must happen even more than that is when you've got these like changes happening in the year, and how you anticipate that can make it even more complicated.
And what are you seeing in the market at the moment? I mean, the title of this conversation is "Cash is King." Now, cash has always been king. I think for every firm, it's the lifeblood that keeps it going. But why, especially now? What are you seeing in the market, Will?
Yeah. So what we see in 2023 is cash has never been more expensive in the last couple of decades. We're being hit by a number of big trends. We've got rising inflation, we've got rising interest rates. It's harder to get debt as well. And on top of that, it was already more complex to navigate kind of what you expect your cash inflows and outflows to be. So cash is getting more expensive, and it's leading to this cash squeeze for a lot of sectors, especially service sectors who are so reliant on doing their service, placing that candidate into a company, and then getting paid 2-3 months later, which makes it really complicated. So I think there's a couple of implications of that. The biggest one is business owners realize that cash collection really impacts their strategy. I was speaking to a travel agency CFO just earlier this week, and he, for the first time, is now measuring his debtor days really rigorously. When they do revenue, how long does it take them to get it in by customer, which is absolutely crucial because they're having all these expansion discussions, thinking the economy is going to pick back up in September, but where some customers are paying them, like prepaying them, others pay them in 60 days. The impact on the business is absolutely huge. So getting that right is phenomenal. And so I think the second implication as well is just so many more business owners, their finance teams below them are measuring cash and some of these metrics that relate into it. So I think for recruiters, one of the conversations they're having a lot is, should we, focus on our big corporates? Should we focus on our smaller customers? Well, we need to figure out who's paying us quickly, what's the outstanding invoices before we can go into those growth expansion plans.
So I guess that brings us on to things like financial forecasting and modeling. So, typically, if you're a recruiter, and I think as well founders as well, it's typically not something that you spend a lot of time doing. Sure, you might put budgets together, but actually that sort of cash flow forecasting, modeling, where's your troughs, etc. It doesn't happen. Is I guess what you're saying, or doesn't happen as much as it should.
Yeah, I think it's one of the big trends is people are increasingly starting to do that cash flow forecast. They've been hit by a couple of big surprises. First, COVID, big seismic change to the business, caused a lot of ripple effects in terms of how commissions are paid as well. A lot more pay when paid. And now this year as well, cash being more expensive. Again, companies have been caught in a bit of a squeeze or with some surprises. And so there's this big increase in wanting to get a better view on where cash is going to be, especially if people are ambitious and they're thinking about how they can grow in Q4. And to make good strategic decisions as a business owner, you always want to be data driven. Recruitment owners I always meet are always super ambitious, super entrepreneurial, very sales driven. But to figure out that space of where they can expand, they have to get that view of what cash is going to be coming into the business, what would the outflows be, and that forward view as well, not just the sales view. And there's a few, really interesting things that recruiters have to think about as well and make it especially important to forecast cash. Firstly, you've got seasonality. I'd love to hear your thoughts about that too. But a number of times in the year where you get these pinch points in cash, and can vary by sector as well. Secondly, you've got these what-if scenarios, especially happening this year. Things like major customers renegotiating payment terms, or becoming a late payer, or backdoor hiring, or maybe even recruiters missing their targets by 30-50%. Figuring out some of these questions, these what-if scenarios, when it's a more changing year than normal, is so useful.
Yeah, there's often a lot of seasonality in businesses. When I think back, working for a PLC, cash was a really important metric. So, pretty much, the last week or 2 weeks of the quarter was around, okay, maximizing cash position, making sure, that if they're things that maybe didn't need to get paid or could put, so just working it and managing cash, because it's a key measure. And I guess that goes for a lot of the reported firms. Things like DSO was super important as well. Days sales outstanding, which is a measure of how quickly you get paid. And but seasonality in recruitment is an interesting one, and typically recruitment businesses grow throughout the year. It's very, and maybe that just reflects firms that hire, but generally the first 3 months of the years are the least statistically relevant, towards the last quarter, where I think November is probably the biggest hiring month in the recruitment calendar. So yeah, typically firms will look at their positions at those potential pinch points. But in terms of firms not paying as well, that's a big thing, and I think it varies a lot internationally. Our experience was that collections were a lot easier in the UK. They're a lot more complex in other countries, and I hope I don't upset the whole French nation, but they were easily worse. You'd have to agree 90-day payment terms, and you get paid when they felt like it. So if your software can model that in, that's impressive.
For sure.
Yeah, very.
I think the interesting thing as well is, like you say, DSOs, debtor days, however you want to call it, it's such real money. If I'm a recruiting partnership, maybe like Construct Resourcing, one of our companies that I think came via your community. But if I'm doing 100K in sales in a month, and let's take a number like maybe 60 days to keep it simple. So I've got these £200,000 in accounts receivable in a given month. If I can cut that down even to 45 days, 25% improvement, really doable, especially if you measure it and use some invoice automation like Agicap can provide. That's an extra 50K in the door that month. And I think now that we're in this year that cash is tighter, growth is a bit more uncertain, business owners are looking for those opportunities, that optimization to manage that cash to get free cash flow in the door.
And I think the other thing that leads into, how optimal is your credit control? So if you actually understand, you can't change what you can't measure. So if you're actually understanding, what your debtor days are, understanding who your debtor clients are, it's super important to basically be working on those. I mean, I remember, I think, looking at the big RPOs and the big MSPs were the biggest customers. They literally owed millions at any given point, hundreds of contractors, and that's not going to be every firm. But I think getting one of those firms to pay was getting the equivalent of 50 smaller firms to pay on time. So if you're going to focus, it allows you to focus your effort on the most important thing. And actually, cash is cash. Every pound is worth exactly the same. So if you can get it out of one customer rather than 50, that's a really good place to start. But you can only do that if you have that really accurate information and you measure it.
Yeah, I completely agree. It's so important. And also when you get that dreaded call, you're going to have to go negotiate with them either for the next round of hiring, and you want to be aware of like what have they paid already, what's outstanding, or if it's the kind of renegotiation question, being super sharp on all the numbers, what's your space to play. That just lets you then decide, okay, my risk appetite is X, therefore I'm happy to go with Y. I guess, as you're saying, credit control has just become more and more important this year as people are more focused on cash. They know it's an increasingly strategic function. We've seen our recruiting customers go through a few stages. Typically 5-person organization, starting out very entrepreneurial, solo entrepreneurs almost. They're probably doing it individually. They're chasing those customers themselves, just handing it over on email or Excel. Then once they get a bit bigger than that, that starts becoming a bit impractical. They're probably outsourcing it to an accounting partner or bookkeeper. And finally, when they get, perhaps 50 employees, they're probably bringing it in-house again. But all throughout that process, the business owner needs to be keeping a sharp eye. This is something you can delegate the process, and you can also automate the process as well with software. But actually having that commercial understanding of where am I today, Who are my main offenders? Who are the customers I like and happy to push business into? Um, Increasingly strategically important.
And the other danger is if recruiters are super successful, that's when it can really start to cause you issues. And I'm thinking back to some of the real life situations I've seen in businesses I've worked in, and also businesses I advise. A really, really good, 2 or 3 months, and then suddenly, all of a sudden, you've got a big commissions bill coming through, and within that, you've got social security on top of that, and
Mm,
then as a result of your extreme profitability, you've got a big corp tax bill at the end as well. So, all of those things, and then people who thought, oh, they're doing really well, and all of a sudden,
yeah, I agree completely. I mean, I really feel for CEOs, leaders, partners in recruiting agencies. I just can see it must be so difficult to kind of figure out where these things are coming from, um, especially sales commissions. It's another area that we've seen evolve for the sector. Probably pre-COVID, there was a wider range of options. Maybe also you did some share options as well.
yeah.
But during COVID, when companies went into these cash squeezes and they got into these uncomfortable positions where people were renegotiating terms or worse, there's been this big rise in pay when paid. If you've seen that, where recruiting agencies are paying their commissions when they get the cash in, which is it's a very solid way of managing cash for the business owners. The problem with pay when paid is it's basically the worst possible outcome for those people getting those commissions. It's super delayed. It's super difficult for them to forecast themselves. So if they're thinking about how they manage mortgage payments or day-to-day expenditure, it just gets harder if their payments are super lumpy as well. So then you've got coming back to more and more structured commissions, maybe with some clawbacks as well in case things go wrong. But then what happens when you have these different models, and especially where you're paying out commission early, it means that forecasting of that cash, especially when you're doing so well, to make sure you don't overtrade, what cash you can invest, what cash you're paying out. So important.
I think one of the really real life examples we saw this year was with Silicon Valley Bank, and I remember the news was pretty bad, and on the Friday afternoon, and our supply group was pretty. It's probably the most active it's actually ever been with people talking about that. And actually, you saw some of the the very experienced business people, and their advice is pretty unanimous. They were like, just stop paying anything. Just literally,
Wow.
we're just going to stop now because we don't know what we've got. We don't know what we've got coming in, and until we know a bit more. And it felt like COVID. No one knew
Mm,
how bad, how big, what the contagion would be on this as well. And I think the thing that was missing from that, and nobody knew where Credit Suisse was going. Nobody was actually where is it? And actually, a lot of the business leaders who knew where everything was were able to make those better decisions. But yeah, it was a very real, very real example this year of something, and they're not black swan events. These things happen. They happened in
yeah.
2008. They happened this year. So people need to learn from that, I guess.
Yeah, it's so interesting. And yeah, for sure, we've seen the implication of that banking collapse, meaning more and more business owners are taking that, more strategic view of where they put their deposits, having a few different bank entities, taking advantage of deposit insurance quite tactically. And then, yeah, for a number of our retail customers who get into these more regular cash squeezes driven by inventory and topics like that, they're always looking for who can we pay later, and then for that, you always want to pay your small suppliers first, assuming you've got good intentions, both from the goodness of your heart and legally, and then you're looking to pay your big suppliers later. So again, that visibility to make those strategic decisions can help people react.
So I guess the last topic is let's talk about vanity and sanity. So it's the old expression, isn't it? Turnover is vanity, profit is sanity, and cash is reality. Is that still true today?
Yes, agree completely, Andy. It's never been more true. Um, I think it's one of the things we see as well when people set up their recruiting agencies, so sales driven, super ambitious and entrepreneurial. And they can create a business that rapidly scales into, the low millions in revenue. So drives super strong feelings about yourself for sure. But it's also an industry with, good, but not super broad margins, maybe 10, 15% net income margins. So maybe if I'm doing 5 million in revenue, maybe I'm taking home 500, 700K in profit. So again, more sane numbers and even better to measure. But if I'm recruiting an agency growing quickly, that cash is staying in the business. And it's even more important to measure that. If I do an extra 500K in revenue, I have to hire salespeople, that's cash out. I have to start paying them commissions, more cash out. And then I've got all the fixed costs of office space, national insurance, and so forth. So a ton of cash outlays. So it's likely months before I'm seeing my cash inflows increase. And the more I grow or want to grow, the more I'm having to put up my cash to finance that growth. I can become the victim of success. So either, cash is the limiting factor in my growth, if I've got a super strong sales org, or the more risky scenario is we've made a small judgment mistake and we get into a squeeze. We're taking out an expensive facility or looking to renegotiate. But yeah, for sure, cash is the one.
So, I mean, what's interesting for me is people talk about, building £25 million recruitment businesses, but they're turnover businesses. The real thing is, what was your operating profit on that? What's unless you're a pure play tech business, nobody buys you on your turnover number. People buy recruitment companies based on the EBITDA.
Really interesting. No, I can see that completely. And where it's so kind of individually driven as well, so useful to make sure what's left for the actual company as well, where you've got a lot of kind of individual recruiters with a bit of a mini P&L. What you take home from that for a partner is that extra layer.
And I think the other thing that, having done work around M&A, is really interesting was that, actually understanding what your working capital is, and any acquirer will need to know what their working capital commitment is before they'll make a purchase as well. So if you're able to demonstrate that, it's just one of those things that just makes you a bit more easy to buy.
Yeah, such a good point. We also work with a lot of private equity funds at Agicap, and one of the first things they're doing when they're looking at a business is trying to figure out, okay, what's my operating cash flow in this business I'm looking at? What's the financing cash flow? What's the investing cash flow? I.e., what's the business throwing off, and what do I need to is coming from working capital management or from their debt. And the more operating cash flow I can figure out, and the more comfortable I feel with that better the multiple I'm going to be paying for that business, for sure.
So look, super interesting. I'm really glad to hear that the old adage "cash is king" is just as important as ever. It's something that I always speak to my customers about, and making sure that number one rule of businesses: don't run out of money. It sounds like obviously Agicap can help you on that quest not to do so. If people want to see the product, how can they get in touch with you, Will?
For sure. So they can reach out to us via our website or reach me on william.fairbairn@agicap.com. We'll post all this alongside the webinar as well. And yeah, I would say 2023, never been more important to have a cash flow forecast. 50,000 businesses are going bankrupt every year due to bad cash management. And they probably all had good accounting and profit and loss intentions, but it was cash management that led them to go bust. 2, measure and monitor your credit controls. Get that cash in when you're being so successful with your sales. And 3, for sure, come talk to us at Agicap. We've got the software to automate all of these processes and help you grow quicker.
Sounds awesome. We'll have to catch up again soon and see how that's all working out for everybody. But thanks again, Will, and thanks for taking the time to do this live with us.
Thanks, Andy. It's been a pleasure.